This content is for informational and educational purposes only. It does not constitute financial, investment, or trading advice. Always do your own research and consult with a licensed financial advisor before making any investment decisions. Past performance is not indicative of future results. Let's talk about one of the biggest financial questions on everyone's mind right now. Are we heading into a recession, a financial panic, or both? Now, I know that might sound a little technical, but stick with me. I'm going to break it down in simple terms and real-world examples so it's easy to follow. So what's the difference between the two? What do they actually mean for your money, your job, your investments, and most importantly, how do you protect yourself and come out ahead? That's exactly what we're going to unpack in this video. A recession is commonly defined as 2 consecutive quarters of negative GDP growth, signaling a sustained contraction in economic activity across the broader economy. In contrast, a financial panic refers to a sudden and severe collapse in market confidence, leading to rapid asset sell-offs, liquidity shortages, and systemic instability. Unlike recessions, which tend to unfold gradually, financial panics are swift and are driven less by underlying economic fundamentals and more by a breakdown in trust within the financial system. The 2008 global financial crisis was a rare and dangerous combination of both. A deep recession coupled with a full-blown financial panic, resulting in cascading failures across credit markets, institutions, and global economies. When people say, I have money in the bank, I have money in the stock market, I have money in the bond market, I have money in real estate, no, you don't. You have stocks, bonds, and real estate. But that's not money. If you want money, you have to sell them. And guess what? Everyone is going to be selling them at the same time because in a panic, the price is collapsing and the potential money you're going to get is disappearing in front of your eyes. If you want yield, you take a risk. And it's not money anymore. One of the most misunderstood concepts in investing is diversification. At a glance, it sounds straightforward. Spread your money across different assets to reduce risk. And while the principle is sound, the way it's commonly applied is often flawed. You probably think you're diversified. Maybe you've got 50 different stocks spread across 10 different sectors. Semiconductors, consumer durables, tech, mining, you name it. Sounds smart, right? But here's the truth most investors miss. That's not real diversification. That's just putting your chips on different parts of the same table. Because when markets crash, and they always do in cycles, all those stocks move the same way. That's lower because they are highly correlated. True diversification isn't about quantity. It's about independence. It's about holding assets that don't all respond the same way to economic shocks. When fear enters the system, the last thing you want is a portfolio where everything sinks in sync. A well-constructed portfolio includes assets that are minimally correlated, particularly under adverse conditions. That's the only way to ensure resilience when volatility accelerates and liquidity vanishes. A foundational component of such a portfolio is gold. Allocating 20% to physical gold, not ETFs or mining stocks, but actual bullion, can serve as a powerful hedge against inflation, monetary instability, and market-wide drawdowns. Gold carries no counterparty risk. Unlike corporations, which can default, or governments, which can fail to meet obligations, gold does not rely on anyone's promise to perform. It simply exists, and it has preserved purchasing power through every economic regime in modern history. That's why building a resilient portfolio means thinking outside the equity box. One of the most underappreciated assets? Cash. People hate cash. It doesn't yield much. It doesn't sound exciting. They say, why would I hold cash when I could be in stocks, crypto, or real estate? But that mindset misses the point. If the market experiences a significant drawdown, say 30% or more, or if we face a global liquidity event that echoes or even exceeds 2008, the person holding cash won't be scrambling. They won't be stuck trying to sell assets at distressed prices. They'll be shopping. They'll be the ones scanning the wreckage saying, here's a quality company down 90%. I'll take it. You know who understands this better than anyone? Warren Buffett. Berkshire Hathaway is sitting on over $300 billion in cash. Not because Buffett is scared, but because he's patient. He sees the vulnerabilities. He knows that in a world of mounting fragility, having the flexibility to buy when others are forced to sell is the ultimate advantage. Next, think high-yield savings accounts, money market funds, short-term treasuries, anything that holds its value and can be accessed quickly. Not only does it help you sleep at night, but it significantly reduces portfolio volatility and gives you a tactical edge in market corrections. Exposure to real assets, residential property, farmland, and income-producing tangibles. These aren't driven by sentiment or quarterly earnings. They're rooted in utility, scarcity, and long-term demand. Because real diversification isn't about beating the market every day. It's about surviving the storm. It's about staying in the game when others are wiped out. And it's about having the flexibility to play offense when the world goes on sale. I've never really subscribed to the buy and hold thesis. Who cares if you just lost 30% of your net worth? Oh, it'll come back. Sure, markets do come back, eventually. But think about how much better off you are if you can get out in front of it and then buy in at the bottom as opposed to riding it down and trying to climb back. If you take the warning at face value and you diversify your portfolio and you're aware of the dangers, you might actually avoid it. Making money is hard. We all know that. But it's even worse when you lose money, because then you've got to make it back. So why not try to avoid losing the money in the first place? There are real-life examples. In 1929, everyone remembers the stock market crash in October. It was down 12%, 2 days in a row. That's a little over 20% over the course of 2 days. And that was just the beginning. The market didn't hit bottom until June 1932. It was down 83%, and it didn't recover the old high until 1954. So if your point is that markets come back, sure they do. But sometimes 25 years is a long time. And by the way, it never really made it back because adjusted for inflation, the $1,000 of 1929 was only about $500 in 1954 dollars. So even after 25 years, adjusted for inflation, you still lost half your money. The dot-com bubble. In the late 1990s, excessive speculation in internet-based companies led to inflated stock prices, despite many firms lacking solid business models or profitability. When the bubble burst in 2000, the NASDAQ Composite Index plummeted nearly 80%, erasing trillions in market value. It took 15 years until 2015 for the NASDAQ to regain its previous peak. So I wouldn't be so relaxed about markets bouncing back. Finally, I don't think people should treat their homes as portfolio investments. I know a lot of people do, but it's a major expenditure, not something you want to gamble with, over-leverage, or treat like a trading vehicle. The same goes for your business equity. If you're a freelance graphic designer, own a small construction company, run a daycare, operate a fitness studio, or manage a local coffee shop, that's your livelihood. You don't want to speculate with that. So, take your home equity and your business equity, put them off to one side. Whatever's left over, those are your investable assets. That's the pool you manage with risk and return in mind, and you can't stop there. If you want to protect and grow wealth in a world that's constantly shifting, you've got to stay informed. This isn't optional. Global markets don't run on autopilot. Geopolitical shocks, trade wars, supply chain disruptions, central bank policy. These things move markets, so tune in, read, watch, listen. Stay sharp. Whether it's through credible news sources, analyst briefings, or macro reports, know what's happening beyond the charts. Because real diversification isn't passive. It's active awareness. It's knowing what you own, why you own it, and what could make it break. It's about structuring your portfolio like a fortress, not a house of cards. If this made you think, go ahead and hit like, tap subscribe, and stick with me. We've got a lot more to unpack. Appreciate you watching. Catch you in the next one.